Yes, I'm very glad to talk about it. Cyber risk management is a project sponsored by the Monetary Authority of Singapore and five global insurance companies. It's a public-private partnership. So this project will actually do really three things. One is the data and modeling, especially analyzing the economic loss consequence of cyber breach. And the second one is cyber risk assessment. From the cyber risk assessment from inside out, outside in, in terms of the data input, data output. The third one is really the policy recommendation, especially how cyber insurance products can be offered. Our main findings is actually very interesting. We found that by studying cyber risk, we were developing a new theory of more like economics of risk management. Basically, has three layers. One is the risk knowledge. A lot of people do not know what kind of cyber threats, do not know about their vulnerability, what their key assets are. And the second one is the economics, risk knowledge. The second one is risk reduction. Many firms now they invest in a lot of money in cybersecurity. They hire people, they buy new softwares, and the question is how much budget actually do they need? And second question, are they spending their money effectively, optimally? So that's really the economics of cybersecurity. It's related to risk reduction. Uh, and so risk knowledge, risk reduction. The third one, risk transfer. And there's always unknown. No matter what you do, still unexpected things will happen. There's a need for risk transfer, so our research is recommending what's the most effective business model for transferring cyber risk, so that reduce the cost and also to overcome this information asymmetry. So that's kind of in a nutshell. That's our main finding. Yes, in terms of data, we have really different type of data. We have collect data of more like case studies. We have about 170 case studies. Those are pretty much public in the media, but you have to gather from different sources. From there, we can actually analyze the the real impact or economic loss, whether it's direct loss or business disruption, and of course, for some of the data really from the U.S. is the legal liability loss, yeah, third-party loss. Major implication is that there is a need for a business approach. Could be cyber insurance. I wouldn't actually label it completely as cyber insurance, but this is a cyber risk management product process that can be offered more in a new way. For example, it's more like a platform based, so that you have economics of scale. For example, cyber intelligence. Once you have the intelligence, you can easily customize and send to different type of companies, and also a lot of it is not just loss and then insurance claim. It has a lot to do with emergency response. Emergency response make a big difference. Actually, most again, right there you have economy of scale if you can offer through a platform, so that it's a wholesale, purchase of that kind of service. So that would generate economic value across the ecosystem. That's actually you summarized really well. It should be government industry collaboration. Even this new business product we're recommending it cannot be treated as traditional cyber insurance. Otherwise, the regulators may ask, well, there's so much unknown risk, you need this much capital. That immediately will increase the cost of offering that product. So this new product, a significant component of it is really service and risk reduction. So that actually would, based on that logic, you would not need a huge amount of capital to offer that service. So again, coming back to your point, yes, it should be a government industry collaboration.